What I have for you today is two tax cases about Skechers, the shoemakers. The first one is from 2015 and it concerns import duties, Canadian import duties on intellectual property, which was attached to the prices of the shoes that the Canadian subsidiary bought from its US parent. The second is publication of a case in 2023 which concerns a tax scheme set up in the 90s, and we will have a look at both. If you want to know what these two cases have in common, stick around and find out. A 10-second commercial. If you want to learn more about international taxation or transfer pricing, or treat yourself to an all-round update, or if you want your team to learn or stay updated, please visit my online courses. First, just a short introduction to Skechers. As you can see, the company was started in 1992. It already made its first $1 billion in net profits 13 years later, and you can see the growth of this group has simply been phenomenal. I mean, making shoes and apparel, they've been selling for $7.4 billion in 2022. So let's see what's going on here. If we look at the Canadian case, Skechers US sold shoes to Skechers Canada, which Skechers Canada then paid for, and the price included the costs of making the shoes, a profit markup for Skechers US, and a cost-sharing agreement, product development payment from Canada to the US, and this was, there were a number of Skechers subsidiaries which were in this cost-sharing agreement. Skechers US would develop the shoes, and we'll see in a moment how, and then all of these subs would contribute to the cost-sharing agreement, implying, one would assume, that they are all partially intellectual property owners, but the case does not address that. So if we look at what happened on, Skechers Canada appeals from a 2013 decision of the Canadian Internal Trade Tribunal, upholding 7 decisions, each one for the years of 2005 to 2011. So these were the import duty adjustments. The decisions of the respondent, that is the Canadian government, concerned the value for duty of footwear of various styles imported by the appellant. The respondent determined that the payments made by the appellant for research, development and design expenses must be included in their entirety for the price paid for the shoes, because they say, you know, these are part of the costs of the shoes. The amount that the appellant pays under the CSA is a percentage of Skechers USA's total cost of these activities, according to a formula based on the ratio of the appellant's anticipated profit, operating profit, to the total operating profits, right? So there's two things to note about this formula. First of all, if you expect to be loss making, you will not be making a contribution to the CSA, I assume. I don't think you get money from it, but you will not be making a contribution because the numerator of your fraction will be 0. And secondly, we're dealing with budgeted operating profits, not actual profit operating profits, right? I wondered initially why they were looking at operating profits, but I think it's a thing to accommodate loss-making companies. And here comes the interesting part of Skechers' operations. Skechers USA undertakes significant research, design and development activities to create its footwear. Of the 40,000 to 50,000 prototype samples that are produced each year, approximately 5,000 become successful footwear styles available for sale. Canada usually markets approximately 1,700 of these styles. Now I don't know what a prototype is, whether it's just different color shoelaces or a different size already means it's a different prototype. But to design 50,000 pairs of shoes and only to take 1 in 10 designs and finally make them seems like you're doing your best in design, and maybe that explains part of Skechers' phenomenal growth. As a result, the court says the transfer price the appellant pays to Skechers US for the shoes includes the cost of the molds and samples leading to the production of the styles which were being imported. However, this price does not include the cost of the molds and samples of unsuccessful styles and styles not imported into Canada. So what the taxpayer tried to argue is they said, you look at the whole budget, but we only import a very small part of that, and therefore you need to cut. You cannot take the full price that we pay for the cost contribution agreement. You can only take, let's say, 10% of it, right? But the lower court has already determined, if you look at the facts and the contracts, then what Canada paid for is only what it imports and what it sells, and it doesn't include the unsuccessful designs or the designs that it does not import and sell. Now that obviously is a word and numbers game, but that's what the lower court has decided. The taxpayer also tried to argue that this included some branding and stuff like that, but the contracts denied that. And finally, this lies on a deeper underlying issue, and that is that apparently, but again, I'm not an import tax specialist, Canada is a bit of an outlier when it comes to import duties, in the sense that it takes this approach that the underlying IP for the design of the product, if it can be allocated to the product, must be included in the import duty price. And then finally, the tribunal concluded that the link between, and this is tribunal because now we're at the appeal court, right? And the appeal court says the tribunal concluded that the link between the R&D payments and footwear imported by the appellant was sufficient. So you could levy with import tax on that. Based on the evidence before it, the tribunal concluded that the R&D and design and development process is an interrelated process, the whole of which is required to produce the goods in issue. By the same token, the tribunal rejected the appellant's argument that the R&D costs relate to intangibles. As outlined above, it is my view, this is a reviewing judge, that these conclusions are reasonable. So Skechers lost the Canadian case, and there was quite a bit of writing about it at the time. Now, if we look at the US case, which was published in 2023, you have Skechers US, and then you've got something called SK2, which is also a US company. And what happened here, Skechers was sold a rather aggressive, in retrospect, state tax planning scheme by KPMG, and is now paying for that. So let's have a look. So Skechers transferred all of its US, not international, and US includes Canada somehow, intellectual property, and then it leased it back from SK2. So in 15 June 1999, Skechers, so this is 7 years after Skechers US was formed, Skechers formed Skechers USA 2, a Delaware corporation. Pay attention to this, as a wholly owned subsidiary. On the formations of SK2, Skechers contribute all of its then existing domestic intellectual property, along with $18 million in cash to SK2 in exchange for 100% of the stock of SK2. So it was simply a contribution in kind. SK2 immediately conveyed the rights to the domestic IP back to Skechers, obviously because they were using it. Under the license agreement, Skechers was required to pay all of its operating margin in excess of 2% to SK2 as royalty. Now, for us as international practitioners, this looks like a US to US case, so why would we even care about it from an international point of view? But remember, if you look at this from a state tax point of view, Skechers was in Wisconsin. All of a sudden they exported their national IP to Delaware, a different country as far as Wisconsin is concerned, and now the Wisconsin tax base is getting eroded all the way down to an operating margin of 2%. It is international tax at the national level, right? And then the court goes on to say in the 2000 assessment, the department denied the entire royalty expense paid by Skechers to SK2, denied the entire balance of interest paid on the net unpaid balance of royalty fees. So Skechers didn't pay all the royalties year on year, and then there was interest due on whatever royalties he didn't pay. And the government adjusted the amount of deduction taken by Skechers for management fees charged to and by SK2. The auditor identified the transfer and leaseback of the intangible assets as a sham transaction or otherwise lacking invalid business purpose. And this was the two angles of attack. A, this is a sham. B, it has no business purpose. And then how did all of this start? Well, KPMG was Skechers' audit firm in 1998, one assume. And it approached Skechers to purchase state tax minimization services. So this was KPMG pushing a scheme onto Skechers. And then you might wonder why Delaware. And here is what they say about Delaware taxes. No taxes on intangible assets. If you reside in another state and your business creates anything that generates royalties, you can move ownership of those assets to Delaware. Intangible assets are anything that is not a physical object but still holds value. If the asset is held in Delaware, the royalties generated will not be subject to any taxes. So federal tax is still due on these royalty payments, but then Skechers and SK2 are completely consolidated because Skechers US holds more than 80% of the shares of Skechers too. So I don't think you see that from a federal point of view. And even if you did, it will be a deduction on the one side, taxation on the other, and it'll be a wash basically. However, for state tax purposes, all the states where Skechers had subsidiaries outside of Delaware, and where Skechers and or its subsidiaries were now paying royalties to SK2, they would get deductions potentially for these royalty payments, and Delaware will simply not tax the royalty income of SK2. Now, the US state taxes are complicated. The way they calculate and allocate their profits are complicated, and this wouldn't be as seamless as I describe it here. But that was the basic idea of the tax saving, right? And then there are some interesting facts that further come up about this case. Okay, on 15 June 1999, Skechers forms the SK2. We know that already. Mr. Weinberg, which I believe was the CEO, stated that Skechers agreed to the restructuring because it was documented the way the company was already operating, and it did not plan to change any of the operations. So here was a scheme that you could just change a couple of documents. You don't have to change anything that you do, and you will save a lot of state tax, right? That is the underlying idea. Weinberg was the chief operating officer or the CEO, I cannot remember. And then in 2005, Mr. Cross, who seems like it was the head of tax, made the decision to no longer require payments of royalty from Skechers to SK2. Mr. Cross testified that he made this decision because states did not like it, no surprise, and he did not want to fight states from now on to eternity over a royalty payment, so he stopped making royalty payments from Skechers. No changes were made to the licensing agreement reflecting the decision by Skechers to cease making royalty payments to SK2. Now this already tells you that the transaction is sham, or in any case doesn't represent a lot, right? If you can cancel it without even cancelling the underlying contract, which was a bit sloppy, but I applaud Mr. Cross for getting rid of the transaction. If the only thing that it does, it creates battles that you're going to lose in any case. And then there was no evidence was introduced indicating any changes to business practices, profitability, or intellectual property took place after SK2 was created compared to prior to 1999. This was an empty shell to save taxes, right? That the creation of SK2 lacked economic substance was reinforced by the testimony of Mr. Stephen Mandel, Vice President of Global Brand Licensing for SK2. Not only did Mr. Mandel only realize that he was employed by SK2 and not Skechers after being called as a witness in this matter, right? So this is way after 1999. But he also testified that he and his predecessors entered into agreements with third parties which did not actually accurately reflect the IP ownership rights of Skechers and or SK2. SK2 only legally owns the domestic IP rights. So here is the head of IP for all intents and purposes, because it's global brand licensing, and he doesn't even know who he's actually working for, right? That shows you to what extent this structure was a scam. And also earlier in the case, the court said, when Skechers entered into this case, it was important to them that as few employees as possible knew what was actually going on, right? So the conclusions of the US court in 2023, or Wisconsin court, petitioner did not have a valid non-tax business purpose for the creation of SK2. Petitioner did not have valid non-tax business purpose for entering into the licensing agreement, and petitioner's licensing transactions did not have economic substance. So the appeal is dismissed. Now, some thoughts about these cases. First, besides both dealing with IP and Skechers US, these cases seemingly have little in common, right? There's some royalty payments, and it's Skechers, and that is about it. But now there is something. Both do stem from Skechers' early years and early growth. And the point that I want to make here was, that whilst the Canadian case decision was unfortunate, I mean, they made an import duty mistake, which you can't really blame them for if Canada is the outlier in how they deal with these transactions. But the US decision can harm, right? So the 2023 decision can really harm Skechers' reputation and attract tax authorities' attention many years after the deed was done. Remember, this transaction was entered into 1999, right? Through all kinds of circumstances. The court decides this in 2023. So in 1999, Skechers barely made $1 billion in turnover. It was not on anyone's radar, right? Today, it is in far more countries. It has a turnover of more than $7 billion. And now you get this mistake from the past popping up across tax media around the globe saying you do really stupid, aggressive things. I don't think if the head of tax now was the head of tax then and knew how Skechers was going to grow, that he would ever have entered, or she would ever have entered, into this transaction. I think this is a main takeaway from this transaction, right? Startups by their nature need to be aggressive in order to survive and climb to the top. I mean, if Skechers was not aggressive in its business and in its strategy and in its growth and in its everything, I think it's very difficult for a company to only be aggressive in some aspects but not in others. And even when you're a startup and you think you're not aggressive, you simply do not have the resource or the experience to be prudent, or maybe as prudent as you should be, right? And then the question is, if and when a company's tax policies then mature and they become more risk averse. So if you look at Skechers today, you've got this court decision from 2023, and they may be tax authorities thinking, Skechers is pretty big in my country, let's see how they're doing. And so the question is now, where is Skechers today? If we look at their annual report from 2022, as note 10 describes, the company's consolidated in the company's consolidated statements, the company's income tax expense for the fiscal year ended 31 December 2022 was 93 million, which is not a lot out of 7 billion, but 7 billion was turnover, right? Of which 7.3 million represented US federal tax expense, 8.3 million represented US state tax expense. Interesting to see that state taxes are more than the total US federal tax. And remaining 77 billion represented foreign tax expense. So if you are a foreign government, you probably can be relatively comfortable saying, these guys are paying most of their taxes outside of the US. It is less likely that there are funny businesses going on here, right? If we go further, we look at the company's P&L and some tax numbers. The earnings before income tax consists of 2020 a loss of 120 million, 112 million, a gain of 71 million, and a loss of 48 million. However, the foreign operations seem to be consistently pretty profitable. 267 million, 500 million, 570 million, right? So there are profits being reported. This does not look like a complete principal scheme where all the profits go to the US. It might be that all the losses go to the US, which explains the US numbers, but that's just the first look. If we then go and look at the income tax taxes, if you look at the foreign taxes again, also in 2021 and in 2020, Skechers paid far more in foreign taxes than they did in US taxes. But if you look at the deferred taxes, there is this funny thing. 16 million in 2020, and then 357 million in 2021 and 7 million in 2020. And I'm not even sure whether these are millions or billions. But if we look at if we try to find out what's going on, there's not a lot of information here. But it says at 31 December 2020, combined foreign net profit, net operating loss carried forwards was 176 million, of which 3.7 expire in 23 and 34 can be carried forward indefinitely. Okay, a valuation allowance of 58 million is recorded for the amount of deferred tax assets, which is not likely to be fully utilized. So either these companies will never become profitable, or it will take so long to become profitable that they never eat up their losses, right? And then we get it. It says in December 2021, the company completed an intra-entity transfer of certain intellectual property rights to Switzerland. Now, I assume it goes from Switzerland, from the US to Switzerland, right? Primarily to align with current and future international operations. The transfer resulted in a step up in the Swiss tax basis of intellectual property rights and a correlated increase in foreign deferred tax assets. As a result, the company recorded a tax benefit of 346 million. So what I think, but again, there's very little information available about this, is that Skechers has moved maybe its international IP offshore to Switzerland, like it did the national IP off to SK2, right? Hopefully the contracts have more substance this time, but there's more reality into the deal. And then what will happen is the foreign subsidiaries will now start paying royalties, or will continue to pay royalties, to Switzerland instead of the US. The sales price in the US is probably used to offset some past losses, so it didn't lead to a huge amount of extra tax in the US. And in Switzerland, you now get a highly valuable intangible, whatever it is that they have transferred, which you can now depreciate over 10 or 20 years, I don't know, and that gives you the tax benefit of 346 million. So while your foreign subsidiaries continue to pay royalties now to Switzerland instead of to the US, I guess, and deduct this, Switzerland earns the money, it is taxable, but it's offset in whole or in part by the depreciation of or amortization of the intangibles that Switzerland acquired. I think this is an interesting case. I mean, we didn't go a lot into tax technicalities today, but it is a stern warning for when you make tax structures that they need to have substance. The fact that they don't need substance back in 1999 comes to bite you ultimately in 2023, and together with that, your reputation. I look forward to discussing the next case with you next week. Most likely it'll be a TP case going into a little bit more technical detail. Bye for now.